morning, ladies and gentlemen. My name is Yoshiaki Abe. I'm operating advisor of USJI. My job is to promote USJI's activities and introduce today's subject for discussion and to introduce the chairperson of the discussion. So I'm going to do one by one. Three things. Very simple. USJI is former, what shall I say, NPO headquartered in Washington, D.C. to promote the policy option of Japan in many fields. And those new ideas are being developed by and researched by 8 universities in Japan. 8 are, of course, I have to remember all of 8, but I'm from Waseda. And Keio, Tokyo University, and Kyoto University, Kyushu University, and I should forget, Tsukuba University, and Doshisha and Ritsumeikan. Doshisha and Ritsumeikan are from Tokyo. Kyushu is from Kyushu, and all others are Tokyo or nearby Tokyo, if you have to remember. Those 8 universities would like to increase the volume of our voices to be known in the world, including the United States. What we are trying to do is present, we think we have policy options on many issues, and through USJI, we do that exercise in Washington, D.C. That is us. So thank you very much for coming here to have a very interesting discussion on the subject, Japan's FDI. What Professor Manier Watanabe from Tsukuba is going to organize and discuss is using model Delphi to analyze American investors in Japan in the form of, I push the button, in the form of direct investment, foreign direct investment. So let us welcome these 3 guys and Professor Manier Watanabe.
I'm going to stay here. It's a lot more comfortable. First, I would like to thank the USJI Research Institute for organizing such a great event. I attended the presentations yesterday. It was most interesting. Maybe it's because we had a lot of VIPs in the room, such as the Japanese ambassador to the United States and Deputy Assistant Secretary of State present in the room. There were TV cameras. There are none today. I'm wondering why. Before I start, I would like to introduce also some of the speakers today. There is James Hoadley, who is Associate Director of the CYBER, also known as the Center for International Business Education and Research at the Georgia Institute of Technology in Atlanta, Georgia. And Mr. James Fothery, who is the President of the US-Japan Business Council, as well as a Senior Director for Japan and Korea at the US Chamber of Commerce. And today, well, we're talking about foreign direct investments. The research I'm presenting is drawn from a lot of meetings, interviews with not only US companies, but also French companies, because, well, in the perspective of full disclosure, I am French, but I represent the Japanese side of USJI, the University of Tsukuba, where I've been working for 5 years now. So, without further ado, so, you may not be fully aware of what foreign direct investment is. Yesterday we talked a lot about the TPP. TPP is more focused on trade. TPP is a type of free trade agreement. Well, foreign direct investments are a little different, but in a way they share a lot of characteristics. Trade is about sending goods from one place to another, usually cross-border, for cross-border trade. And for foreign direct investments, well, it's about, by definition, gaining a measure of control and investing in a different country, in a different company, in a different country. And by definition, the threshold for FDI is 10% of the stock of the recipient company. So if you think of portfolio investment, maybe some of you own some stock in the stock market. If you own less than 10% of the stock of a company, well, that's not foreign direct investment if that company is outside of the US if you're American. It's just portfolio investment. Here the point is long-term investment. You're not just buying some shares for quick return, but for, again, maybe long-term returns. Why is FDI important? Well, I'm from the academic side of things, and there's lots of research about how Japan has invested heavily outside of its borders. If you look at all the great manufacturing plants in this country, in the United States, well, there's lots of research about this, but very little about the investments inside Japan by foreign companies. Why? Well, one of the reasons is that there aren't many. I will show you some data in a few minutes, and investments in Japan by foreign companies are very, very small. Another reason that tells you the importance of FDI is if you look back a couple of years or even decades, well, you all know about the double decades of stagnation in Japan, but it got worse with the disaster that occurred on March 11th, 2011 in Japan. And Japan has had to get back on its feet. And I think foreign direct investments is a good way for it to kind of regain its standing and maybe not only recover from after the disaster, but also recover from those 2 decades of stagnation. And also FDI in general, well, it's not good only for Japan, but I think it's also good for the United States or any other country involved in it because, well, there is a market over there. And although Japan has been stagnating for 20 years, there's still great opportunity. There are great companies creating great technology. There are segments, customer segments, who are willing to buy. Because if you look at the savings rate in Japan, well, it's very positive. In some parts of the United States, the savings rate is negative, right? You're living on credit. So of course, selling to people who have money makes a lot more business sense than to some people who don't. So for US companies who want to expand, it's also a great opportunity. If you look at the types of FDI broadly, it's either greenfield, you just go there, you enter Japan and you set up your own operation. Maybe it's just an administrative office, maybe it's a factory, or it's M&A, which actually numbers show that M&A is the predominant way of entering Japan. Meaning, well, I'm not doing it my own way by myself, I'm just buying an existing player. Typical example would be Walmart, which purchased the retailer Seiyu. And why is that an interesting example? Well, Walmart entered Japan in 2004, I think. And at the same time, its main competitor, Carrefour, French company, they entered Japan as well. It's not random, actually. Carrefour entered and Walmart was thinking, okay, we need to be there because otherwise Carrefour is going to lock in the market and we're going to be shut out. But the big difference is that Carrefour came in on its own. It was greenfield. Well, Walmart, they thought, we're not going to do it on our own for several reasons that I explain later. They purchased an existing player. And we see that in terms of foreign direct investments, usually when you enter a mature market, well, depending on the industry and certain conditions, it makes more sense to acquire an existing local player if you can find one, and if that local player is willing to be acquired by a foreign company, which in Japan has been a problem for a long time. Again, there are lots of benefits to FDI. It could be resources, not only labor, but it's especially technology when you think about foreign direct investments or know-how. Of course, it creates employment, productivity, but it's also an indicator of openness. And again, the numbers show that Japan is not so open. If you look at the trends in the past 10 years, developed countries have been the main source and recipient of foreign direct investments. Well, what that tells us is that, again, a lot of the FDI that's being done is horizontal. That means you're buying market share. You're replicating a certain business model that you've had, usually in your country of origin, to another country. For example, okay, I'm selling that product in my country, and I think there's a market opportunity somewhere else. I want to do the exact same thing in that other country. By opposition to vertical FDI, where basically you are spreading your value chain across different countries. For example, okay, manufacturing in China, for instance, customer service in India. This is more vertical. If you look at the trends again, well, the OECD as a recipient of the global FDI inflows has dropped the share of the OECD. For instance, in 2000, the OECD as a whole were receiving 87% of global FDI inflows. 2008, 60%, 2010, 55%. So in just 11 years, 10, 11 years, it dropped from 87% to 55%. Where did the rest of the FDI go? Well, mainly to the BRIC countries. This is not a surprise. If you think China, India, and to a lesser extent, of course, Brazil and Russia. What is very surprising, if you look at the inflows and stocks of FDI as a percentage of GDP, as is customary to measure it, for Japan, it stood at 0.1% for Japan over that 20-year period, compared to, well, let's just look at it for the OECD countries, 1.8%, 18 times more, or 2.9% for the EU. So how come Japan is attracting 30 times less FDI than is the EU zone as a whole? Well, this is not new, but something should be done about it, because there's still a lot of good life out of Japan as a country. And of course, the type of FDI that Japan is attracting so far, it's mainly about manufacturing. If you look at it, 40%. So just for you to have a better graphical depiction of this phenomenon, well, you see Japan in red at the very bottom, and well, it's a lot less than the other countries, of course. Well, there's been a lot of research also about the barriers. My point here is not to list all the barriers to foreign direct investments, but Japan has been labeled as a fortress in a recent survey by the European Union by more than 75% of EU managers that were surveyed for this purpose. And of course, as we heard yesterday in the TPP presentations, well, it's because of some non-trade barriers, discriminatory or non-discriminatory trade barriers, but the TPP agreement and FTA agreements in general focus on these non-trade barriers. And as I said before, here I'm talking about trade because foreign direct investments and trade share a lot of things in common, especially when it's about horizontal FDI, when it's about market share and selling the same products in another country. The main culprits, if you look at the list, well, it's mainly language barriers. It could be structural barriers. The legal system is different. The M&A practices are different. The public procurement practices are different. And at the bottom of the list, which maybe should have been at the top of the list, is a system of cross-shareholding. As you know, we have Keiretsu, or vertically and horizontally integrated companies around a main bank and a trading company, and a lot of these actors own a little bit of the capital of each other, forming in Keiretsu. For example, if you think about the Toyota Keiretsu and the Mitsubishi Keiretsu, well, it's very difficult to break into one of these Keiretsu arrangements when you're an outsider. So the research that I've done with a French partner at one of the top business schools in Paris, well, we decided to start from a blank slate. Of course, we know the literature, we know about foreign direct investments, but we decided to talk to actually experts and practitioners. And because I'm French and my research partner is French, we thought, okay, let's talk first to French C-level individuals in Tokyo. And we use, well, Delphi methodology just means we do several rounds of interviews by refining our model. And this is just a snapshot of a few companies that we either interviewed directly or for which we got a lot of secondary data. For example, LVMH, Louis Vuitton for the ladies, especially Japanese ladies. You should be familiar with that name, and maybe you're a good customer. Thank you very much. Well, they've been in Japan since 1978, for instance. You have BNP in the banking industry. They've been there since 1867. So you can see already that some of these foreign direct investors are what are called veteran FDI investors. We have Saint-Gobain, which is a very large company in the habitat and construction industry, Merial, which is in animal health, Renault, Thales, which is in electronic systems and defense, for instance, Valeo, which is an automobile supplier, for us as well. Well, you get the idea. So what did we do with that? We decided, after a first round of interviews, after everything we heard, to create a matrix to really get the meaning out of the interviews. And the first dimension was basically greenfield versus M&A. How do foreign direct investors enter Japan? Well, it was either or. And also, the second axis told us, well, we should look also at the market maturity. There are different types of segments in Japan. Some of them are, well, arguably highly mature, saturated with very sophisticated customers. And some of them are just barely, emerging, actually, around new technologies, around elderly care, for instance. If you just around technology, maybe you don't know the term monozukuri, but maybe I may be able to spend some time later on this. So this is what it looks like. Based on our research, we found that, well, you have either M&A or greenfield for the nature of the investment, and for the market maturity, it's either high or low. And we ended up with 3 categories. Because if you look at the one with the big cross in the top left, well, high market maturity, greenfield, it does not really happen. This is suicidal. Remember the example of Carrefour, which entered Japan at the same time as Walmart? Well, today, Walmart is thriving with its acquisition of Seiyu. Carrefour, they left. They left 5 years ago. It just didn't work out. If it's a highly mature market and you want to do it on your own and you're a foreigner in Japan, you have no brand awareness, you have no connections or very little, it's not going to work. If you look at the other categories, well, the first one, rescuers, is very intuitive. And maybe Walmart falls in that category. Takeover of ailing local company. Another good example was Renault in 1999. You know that Renault acquired 44% of Nissan. Well, why did Nissan decide to just give away 44% of its capital to Renault? Well, because Renault is a great company, right? No. It's because they had no choice. It was either this or bankruptcy. So Renault played the role of the white knight in this case. And, well, the tables have been turned since. And Nissan is doing a lot better than Renault today. But the point is, they're in it together through the Renault-Nissan alliance. So that's the rescuer quadrant. Then we have the cherry pickers. The cherry pickers, it's basically, okay, this is not a mature segment, and you want to acquire a promising company. Maybe it's a company in need of capital, a Japanese company that has proprietary technology that is in a niche market, and you think that, well, it could complement maybe some other activities that you have inside your company. And the last one is niche players. Well, it's low market maturity, but you want to do it on your own, and you fill a gap with differentiation. Some examples of this could be, for instance, Merial. It was in the list. It's in animal health. Basically, they do vaccines. They're very famous in the United States through one of their leading products called Front Guard. If you have a dog, chances are you're using Front Guard. Frontline Hard Guard. Frontline Hard Guard. I'm not a pet lover, sorry. Well, they have brand name, they have patents for their products, so it's easy to enter in Japan this way because there's very little competition. For the cherry, just to go back to the cherry pickers, to give you an idea, Saint-Gobain, which was a large company I was talking about in the habitat and construction industry, they acquired a company called MAG in the insulation segment from Japanese companies. And they thought, okay, this would be great to complement our value chain and our offering, not only in Japan, but worldwide. and they decided to acquire it. So I know that actually I'm running out of time, and what I want to say is that, well, let me focus maybe on the prescriptive matrix. Beyond description, it's not about saying, okay, this is what investments look like. It's more about giving, not advice, that would be not really the case here, but maybe some keys or some indicators for foreign companies, especially American companies, on how to invest in Japan depending on the situation. And, well, for example, if you look at the rescuers, it's all a matter of guaranteeing corporate liquidity. Again, when Renault purchased Nissan, they just needed cash. When Walmart purchased Seiyu, well, Seiyu was in trouble. But the point is, Walmart did not change the name of the acquired company. If you go to Japan today, you still go to a Seiyu supermarket. They have adopted a lot of the successful Walmart practices in the back office, of course. They've been integrating that company inside the Walmart system. But the point is, the customers still see the familiar name that they've known for 50 years. So they still want to be localized. They want to be seen as a local player. Another point is guarantee the welfare of the employees. And sometimes it is seen as a condition for the acquirer to lay off as few people as possible. Of course, as possible. Of course, when Renault purchased a sizable stake in Nissan, they had to let go of some people to kind of, well, to turn things around. And the most important to me right now is leverage established business relationships. Well, this is one of the reasons why rescuers buy an existing company. It's because if you buy an existing company, well, you can leverage the relationships of that acquired company. If you do it alone, well, you're alone. You don't have any what is called a shokai, an introduction, when you go into Japan. You need to have somebody to say, well, let me introduce you to a valued partner, for instance. So you need that insider track in a way that's afforded to you by buying a local player. If you look at the niche players up there, well, it's all about finding companies for sale. And actually, after meeting extensively with several people at BNP Paribas in Tokyo, that's the main problem. They have access to big or large deals or large companies for sale that nobody wants either, because maybe there's a big problem with their liquidity or their strategy. But they don't know about those small companies that maybe could be, I don't know, either those segments that are available or those companies that for sale that would be for cherry pickers, for instance. You need to get financing. And actually for niche players, well, if you think about the long run, you come into Japan, you want to do your own thing. Well, it may take 1 or 2 years. I spoke with Saint-Gobain. Saint-Gobain actually uses different strategies. At some point, they're niche players. At some point, they're rescuers. At some point, they're cherry pickers. When they're niche players, they know that they need to be able to rely on only one product for about 2 years. Why? Because Japanese companies take a risk when they give their business to a foreign supplier. Well, I don't know you. You don't have any track record in my country. And if you don't have assets in Japan, well, it's very difficult to do business with you, because we may want to co-develop some products. We may want just-in-time delivery. We may want local customer service. So you need to have an established presence, not only a sales office. So in the case of Saint-Gobain, it's interesting to notice that they consider being present in one country only when they have a factory in that country. A sales office does not count. And this is the right way of thinking for Japan, because this is what Japanese customers want and demand in order to give business to a foreign supplier. And the last one, cherry pickers, well, it's all about knowing, again, the market and who's available. In the case of Saint-Gobain, again, they created the Saint-Gobain University Network, and they have partnered with a number of research labs in the Tokyo and Kyoto areas dealing with material science, because this is their business, in order to identify maybe intellectual property or companies linked to these types of research that can maybe acquired in the long run. Actually, it has led to 3 acquisitions so far, but none in Japan. They're still working on it. In conclusion, because we're running out of time, unfortunately, maybe we can address more things during the Q&A. Well, there's a predominance of niche players. But these niche players have become veteran niche players. Remember the Louis Vuitton and BNP. There are some other companies like Air Liquide, which is one of the leaders in industrial gases. They've been in Japan since 1907 because they had set up a factory at that time. Just 4 years after being created in France, that company set up a factory, a gas factory in Japan at that time. Usually, large companies use a multitude of entry strategies for these foreign direct investments. It could be, again, in the case of Saint-Gobain, cherry picker, niche player, rescuer. What I found out is that, well, I told you M&A is the most common in terms of value. Although I said there's a predominance of niche players in volume, but in value is a predominance of M&A. M&A deals tend to be bigger. And how do they go down? Well, in general, it's either the companies having financial problems. Again, Nissan, they were on the verge of bankruptcy. That's the first case scenario. Second case scenario, it's a family-owned company, and nobody is willing to take it over. There's no heir, no successor that says, okay, I want to step it up and take over daddy's company. So they're kind of stuck. Nobody has the expertise or the money to take it over. And the last one is a conglomerate wanting to shed some non-core business. But these 3 case scenarios have one thing in common. It's always financial at the end of the day. They only give themselves up, and this is how they see it, to foreign investors if there's no other financial option. Otherwise, they would take a Japanese rescuing company any time of day. So I think what's important here is that to recognize that there are different cases. Foreign direct investments do not have to be large companies. They can be small companies. They can be at different stages in their growth, either domestic growth or international growth. I believe, having lived in Japan for 8 years now, that there's still great potential, but it really relies on a network of acquaintances and contacts that can give you an edge in the quality of the information on the ground. Otherwise, you're kind of in the dark and you're kind of shut out from all these, not lucrative deals, but these deals that make sense for the foreign direct investments as well as for those little firms who want some outside capital and maybe access to foreign networks or foreign distribution networks. Thank you very much.
As we're getting set up, I'd like to say that I really hope that tomorrow the International Olympic Committee will make the correct choice and will announce Tokyo as the host of the 2020 Summer Olympics. The 1964 Summer Olympics was really a coming out party for Japan, reintroducing it to the world after World War II. And I think that 2020 has the potential to reintroduce Japan to the world yet again. And I hope that Japan has the opportunity to do that. I'm here to talk about foreign direct investment in the state of Georgia, which is where I live. I work for the Georgia Institute of Technology. The state of Georgia, those people who work in foreign direct investment, particularly who work in the United States, I don't think I'm going to say anything, reveal any secret sauce here that Georgia has that no other state has. But Georgia makes a very concerted effort to attract foreign direct investment. For 2012, we attracted $2.82 billion worth of foreign investments. That was new foreign direct investments, creating 6,500 jobs. Those who've been paying attention to the American economy know that job creation is a very important thing. The total capital investment in Georgia, over $23 billion. Statewide, now these are not just Japanese companies, you can see over 3,500 foreign-owned companies, over 2,800 of those are in the metro Atlanta area. Let's see, and over 190,000 people plus are employed directly by foreign direct investment. These are not numbers that include people who are ancillary, the people who support these foreign direct investments. These are people who are directly working for foreign-owned firms. And as you can see, in Georgia, we love Japan very much. In terms, there are 385 Japanese firms, just Japanese firms, doing business in the state of Georgia. And they employ 23,000 people. Directly. And the names are some of the best names. We have some that I saw that were on the list of people who are here: Itochu, Sumitomo, Mitsubishi. You're all in Georgia, and we thank you very much for your investment. Here is a map showing the clusters of just Japanese. These are just Japanese-owned firms in Georgia. You can see most center around Atlanta, with a smattering across the other locations. We in Georgia, and particularly in Atlanta, do, I think, an exceptionally good job of collaborating and working together to attract foreign direct investment. I'll go into a little bit more detail on that. One of the things that Japan has going for it that Georgia is doing as well, that I think that if Japan makes a decision that it wishes to attract foreign direct investment, it will be very successful at doing so. Georgia has managed to get a wide range of diverse players all moving in the same direction with the same goal, to promote foreign direct investment. It's not one organization is pushing it and nobody else is. It's a matter that everybody across the board wants foreign direct investment in Georgia. And I think that Japan is a country, in my experience, that when everyone makes up their mind to go in the same direction, everyone goes together. So in the state of Georgia, we have a number of things. We have the state, Georgia Department of Economic Development has a dedicated team for attracting foreign direct investment. Not a person, not a person who's part-time. They have a team of 6 or 7 staffers whose sole job is to go out and attract foreign direct investment to the state of Georgia. We'll look at their website, which I think is really amazing, although I'm sure there are other states that have websites that are just as good. But anyway, we'll just use it as an example. The Metro Atlanta Chamber of Commerce also has a staff of 4 or 5 people who are directly focused on promoting foreign direct investment. Let's think about that for a second. This is the Metro Atlanta Chamber of Commerce. The members of the Metro Atlanta Chamber of Commerce are pre-existing businesses in Atlanta. Pre-existing businesses in Atlanta are saying, we want to bring in foreign direct investment, possibly competition. And everyone is on board with that because they believe that by having more foreign direct investment, it brings more money, more wealth, more customers, it grows the city, it makes us a destination that is internationally and globally significant. Also, the Metro Atlanta Chamber, they have a committee which I actually sit on, which is the Global Commerce Committee, and we have a report, a quarterly report. And at the end of the year, whoever in the Global Commerce Committee has attracted the most foreign direct investment, you get a prize, a rather nice one. I think this year it's a 4-night stay in Punta Cana or something like that. So it's kind of cheesy and everything like that, but really it shows that people are interested, people are moving in that direction, and there really is a drive towards attracting that foreign direct investment. See, the state and local governments, this is an area where Japan is kind of hamstrung by the centralized government. You can't offer tax incentives in Japan if the tax structure is the same in every location. Georgia has a low tax structure relative to other states, particularly in the Northeast. Also, local municipalities have the ability to offer tax waivers. I worked for a Japanese-owned auto parts supplier in South Carolina, and the local municipality there was offered a 6-year property tax holiday. They were given the land on which they built their factory at $1 lease a year for 15 years, something like that. These were all incentives that were offered primarily by the local government and also by the state government as well. Also in both Georgia and South Carolina, the state-supported technical education system, which you don't really have in Japan, the state technical colleges have been made available to train employees to work in factories, to learn, they structure their curriculum specifically to produce the, the information and knowledge that the employees need to work in these firms. And infrastructure improvements. Constantly, Atlanta is helping to pay to dig out the harbor in Savannah, because we realize that having more products coming into Savannah will benefit Atlanta as well. We have also created in Georgia an inland harbor, which is things come into the port of Savannah, they are loaded on a train, a special train on a dedicated line, which is taken several hundred miles inland and then processed through customs and all that inland as opposed to at the port. It allows us increased flexibility because all you have to do is throw the containers off of the ship and onto a train. And educational institutions, including the educational institution for which I work, help both to train future employees, and we also help in some other ways as well, and I'll show you in just a second. So here is the Georgia website. You can look up a directory of all of the international companies that are already present, and you can look them up by nationality, by size. You can see if your partners are there. When we attract a firm to Georgia, we don't just attract that firm. We use referrals from the anchor that we have attracted. Like, for example, a few years ago we announced that Kia had a large plant in Georgia. As soon as Kia announced that they were building a plant, the very first thing after that was sealed, was determined, we set about trying to attract Kia's suppliers. We asked Kia, who are your suppliers? And then we went to them specifically. We sent people to Korea to recruit Kia suppliers. I think the available buildings thing at the top is, I think, a stroke of genius. If you're looking, most people who are searching for foreign direct investment today don't do things the old-fashioned way. They don't get out a book, they don't hire a consulting firm to do it for them. They Google it, or in the case of Japan, they go to Yahoo and they search there. And you want to make sure that when people are Googling or looking for, when they find your stuff, they're able to immediately start acting on what they were interested in. Showing them what buildings are available, what commercial buildings are available. This is just a listing service by the state. They are owned by private entities, all the back end and the real estate and everything like that, that's all handled by a private entity. The state simply lists large commercial open spaces and says, hey, here's something you want to come and invest. And if you do, talk to us and we'll get you a sweet deal. Okay, here's the Metro Atlanta Chamber. The Metro Atlanta Chamber, as I said, I kind of went over it. It works very hard to attract foreign direct investment. We have in the team that attracts foreign direct investment, they have a pre-prepared set of basically all the information that we would expect that foreign direct investment would want. And the team actually will go out and meet with those foreign direct investors, potential investors. And we use a lot of relational marketing to try and attract additional investors. Now I said higher education institutions, of course, we provide training. Georgia Tech also offers a co-op program, which approximately 60% of our students participate in. We were just visited by, again, a Korean firm a couple of weeks ago who was interested in hiring co-ops from Georgia Tech. That co-ops, the advantage to co-ops is for highly trained people. Essentially, you bring them in, they work for a semester, then they go to school for a semester, and back and forth. They get paid, they get real on-the-job experience. You have no commitment to them, but it's kind of a 4 or 5 year interview process at the end of which you can decide whether you really like them or not, or if you want to let them go. Most cases, people want to keep them. And in most cases, when people don't go to work for the company that they co-op for, it's because they had a better offer somewhere else, even better than what their co-op sponsor could offer. The Enterprise Innovation Institute is funded by the state at Georgia Tech, and the Enterprise Innovation Institute encompasses many, many things. One of the things that it does is it works with small and medium-sized enterprises that have suffered as the result of global trade. It identifies these firms. In the recent past, there have been a lot of companies that were involved in the textile industry, for example. Textiles almost entirely gone from the Southeast now. But one of the things that the Enterprise Innovation Institute did was they would work with these firms individually, and they would say, how are we going to restructure? What can we do with what you have here? We come in at the Enterprise Innovation Institute, and we're kind of turnaround specialists. And in some cases, the turnaround has been, in fact, in many cases, the turnaround has been, we prepare them to be acquired by a foreign entity. The largest textile company that is currently working in Georgia, I think if you exclude carpet, is YKK, the Japanese firm. They have these plants all over the place, and they are amazing if you go in them. They are huge plants, running with machines, and there's maybe 4 people in the whole plant of 100,000 square feet. That's, that's amazing to me that it runs like that. But there are still some jobs there, and there is still production being made there, and many of these cases, Tapecraft, for example, is a company that manufactures seatbelts that was acquired by YKK. It was a small and medium-sized company, and the Enterprise Innovation Institution and the state Institute and the state of Georgia worked together to get them acquired by YKK. I've kind of covered most of this. The state of Georgia does maintain offices abroad for states that or for countries that we wish to attract foreign direct investment. So it's kind of JETRO, only on the state level. And we do have one in Japan. You can see, I do kind of take umbrage with the one that is Europe. It has 3 people, and they're all in Germany. Europe is not Germany. Another thing that makes Atlanta appealing is what I like to call personal support. People make decisions on where they're going to invest, not just on the basis of where it makes business sense, but also where it makes personal sense for them to locate. In Atlanta, one of the advantages that we can roll out for people is that the cost of living is quite low. It's 5% below the US average. Housing is 10% lower, utilities are 15% lower than the US average. And we're able to capitalize on that and say, hey, you can come here, you can have a much nicer house than if you decided to locate in California. Your taxes will be much lower personally. And we also work with our educational system. I know that we've taken a number of black eyes recently, particularly with the Atlanta Public Schools cheating scandal. But moving beyond that, we do a lot of work with educational institutions to make sure that our foreign investment people have good schools that they can send their kids to. We have a Japanese language school in Atlanta that Japanese executives can send their kids to. We also have very strong international communities. We have, the number is much larger than our number. We have a huge number of foreign consulates. We have an even larger number of binational chambers. And those work very hard to promote ties between a particular country and Georgia. In the case of a consulate, the advantages of having a consular section in your city are just indescribable because it makes life so much more convenient for foreign nationals living from that country living in your city. A binational chamber as well works to support those companies and to bring them together into partnerships that they may not necessarily get into in their home countries. So the keys to Georgia's success: public-private partnership. It's not that the government is doing one thing on its own. It's not that the companies are doing one thing on their own. You have the Metro Atlanta Chamber working together with the Georgia Department of Economic Development. You have a clear strategy, everyone's committed, there is public acceptance and support, and all the relevant entities are aligned. We're all moving in the same direction, that we all want foreign direct investment. We have competitive costs, and we have a developed support structure. So how do you attract foreign direct investment? You have to get buy-in from relevant groups. That's what I keep saying this over and over again. Japan, I think, is the best country in the world for getting everyone's buy-in to a particular decision. So I think that Japan could become a great foreign direct investment target on that basis. You need to select the particular targets. You need to target particular industries, countries and regions that seem to make sense, and specific companies and investors. You can't just go out and put out a billboard that says invest in Japan. You have to specifically identify these are the people that we think would be good investors, and you have to go out and you have to target them. And the literature that you create has to be available on print, and it has to be available online. I recently saw Invest Miyagi has a website. It's pretty good, and I think that it could be a template for other areas. In Japan, Invest Miyagi is trying to attract foreign direct investment to the areas affected by the March 11th tsunami in 2011. And translation is not just, you don't just translate. I think I have my next slide. And when I say translate, don't just translate. Here we have the two most popular websites, one in the United States and one in Japan. Other than the text, even if you couldn't read the text, even if I had blurred it out, you could still tell which one was the most popular Japanese website and which one was the most popular US website, because Google, very, very clean, very, very minimalist. So if you're making a website to try and attract American investors, it needs to be clean, it needs to be minimalist. If you're making something for the Japanese, it can be very, very busy. I've seen a lot of Japanese websites that are translated into English, and they're full of text, and people get scared by that. Oh, okay, the reason I repeated the slide is it was halfway through. Okay. Cultivating direct referrals. If you have companies that buy national chambers, you want to get people invested in attracting foreign direct investment to their community. There's actually a lot more international connections in your community than you realize, even in Japan. Let's see, attending investment trade shows, that's obvious. Engaging the broader community, and encourage the development of support structures. See what you can do to encourage, if you have a bunch of disparate companies, but they're all from the same particular country, see if you can encourage them to develop their own binational chamber. That in of itself will pay off, but it's a process. It's not something that can be done overnight. Everyone has to be aligned, and that takes a long time. But I think that if anybody can do it, Japan can do it. Thank you.
Thank you. I want to thank Remy for inviting me to be on the panel, and Dr. Abe and the U.S.-Japan Research Institute for sponsoring this. I think it's a good topic. I'd like to commend my colleagues on the panel here for, I thought, what were excellent presentations, very different approaches to the topic, but I'll try to integrate this as much as I can. But I appreciate very much your approach in trying to frame the broader discussion and the very practical kind of things that you bring to the discussion. I'm not burdened by the need for academic precision or empiricism, and so I'll just speak using a little bit of data drawn from OECD and Thomson Reuters to show some M&A data. But really I want to speak from the perspective of someone that's been engaged in the business community for a number of years. I've relied a lot on discussions ongoing with my colleagues at the American Chamber of Commerce in Japan, who are on the ground in Tokyo and are doing this stuff all the time, but also the members of the U.S.-Japan Business Council. For years we've been focused on this issue of how to get more foreign investment, more particularly, I think, as both Remy and Jim suggested, more opportunities in Japan for foreign investment. And as I'll point out, there is great potential in Japan, but I think there's a great gap between the potential and the performance, which I'll show you. To start out, I just want to emphasize a couple of key points. First, to reinforce something that Remy said, Japan is just such a major outlier on any indice of global FDI that you can look at, whether it's just a percentage of GDP or if it's on the annual inflows of FDI into Japan. Japan is just remarkably and strikingly low relative to the OECD countries, which I think are the comparator for Japan. FDI in Japan on a stock basis is under 4% of GDP, and that's quite striking. I've got a graph that I'll show you. Something striking also that I think Remy mentioned, in 2010 and 2011, Japan was the only major economy in which net FDI was negative. And now 2011 could have been a unique year because of the 3/11 disaster, but it was also negative in 2010. And so that's something that's quite remarkable if you look at the FDI levels that are in other countries. So where in the United States we've had years in which there have been $100+ billion invested, or even much smaller economies in the United States, you've got $50 billion invested on a flow basis. In Japan, I think the peak year ever in the second or the third largest economy in the world has been $20 billion or thereabouts, which is just not where it could or should be. And then the other thing to note is that if you look at the ratio of Japan's inbound versus outbound FDI, it's about a 1 to 5. And that's much different than the other major economies where you've got more of a 1 to 1 or closer to that kind of balance. Secondly, the major point I would make is that this dearth of FDI in Japan is actually sapping it of some economic potential. Work by people at the American Chamber of Commerce, particularly they commissioned a professor named Kao, I think from Hitotsubashi University, about 4 or 5 years ago, to do a very extensive study of FDI in Japan. It showed that foreign companies were more profitable, they get higher returns, they generate most of the new employment in Japan in recent years. And so I think there's this missing element in the Japanese growth picture, which could be filled in part, not full, but in part by FDI. And I think the other thing that's a little bit harder to quantify is what happens when foreign companies enter your market. They bring in new management techniques, they bring in new production techniques, they bring in new ways of doing business, which both amp up the competition in your domestic market, but they can also spread. And so these new methods can basically increase the dynamism of the overall market, or to use a phrase that's being thrown about in Japan now, they can help increase the corporate metabolism, which I think in Japan is a really critical piece of the overall growth picture. So now a little bit of good news at the top here, which is that the Abe government has done the analytics. They recognize the problem, they're focused on it, and they're going to try to do some things to increase FDI in Japan. There's a lot of talk about making Japan the most business-friendly country in the world. That's an ambitious target. Japan's got a lot of positive attributes, which I will point out. And the question is how they go about this and whether they do the right things. So just to embellish the point, this just is inward FDI stock as a percentage of GDP, and you see Japan at 3.4. Now, it's significant. In the year 2000, when Prime Minister Koizumi took over, that number was about 1.3, 1.4. He had a target of doubling FDI in Japan. I don't think they actually technically doubled it, but it's substantially better than it was, but it is still remarkably low. If you look at the developed country is the OECD average. So the OECD average is 31% of GDP for inbound FDI, and Japan is lower. Here's the chart to describe, I think, are some of the key elements of Japan's potential. We all know it's the third largest economy now. You've got a 6 trillion economy, you've got high per capita incomes, you've got high profitability of the foreign players that are in Japan. And so what that shows is that the companies that are engaged in the market can actually be very successful there. And that's not lost on foreign companies. You've got the educated skilled labor force, you've got sophisticated and good technology, you've got very good infrastructure, and you've got potentially very good industrial and strategic partners in a lot of significant technology-based industries, chemicals, the IT area, energy technology, and so forth. What I would describe as the main problems with performance is that you've got this ongoing slow growth dynamic, and you've got rigid systems that contribute to that. So you've got labor inflexibility, you've got a highly regulated economy, you've got some things that make the Japanese business environment less optimal than it could be. And I think the Abe government is focused on that, and so that's to its credit. To touch on the greenfield argument, if you look at Japan's cost relative to those in the Asian neighborhood or other places that are prime FDI destinations, they've got high costs for land, high costs for labor, energy costs are high, and they've gotten higher after the Fukushima tragedy, and so that's not in Japan's favor. The incentives, I can come back to this, but they are centrally allocated or administered, and so that's a problem, as you pointed out. But if you look, and this is somewhat anecdotal, but you can look at the data. If you look at what Singapore offers, for example, versus what Japan offers, Singapore is more advantageous just in terms of the strict incentives. Now, incentives aren't the decisive factor in making an investment decision because it comes from a broader decision process, but they can contribute certainly, and they're more than marginal. I mean, they can be important, but they're not the decisive factor. And then lastly, the thing I want to emphasize is that it was interesting the way that you noted that M&A is the primary means by which a lot of FDI in Japan is occurring. And I would essentially agree with that, but what I'm going to show you is that even though that may be the case, it is still strikingly and again remarkably low relative to the rest of the world. And so the point here to emphasize is that Japan is a very difficult market for M&A. And if you look at the numbers here, you see for 3 different years recently, Japan is just substantially lower than the other economies in terms of inbound M&A. Very, very low levels there. The other point to note is that if you look at the escalation in Japan's outbound FDA relative to the inbound, it's still it's an enormous gap. Japanese companies in the last few years have been increasingly aggressive about seeking M&A opportunities abroad. I should have put up a table to show some of the cases, but anecdotally, Japanese companies in the healthcare sector, in the energy sector, in the IT sector are active acquirers in the US market, in Asian markets, and even in Europe. And I know in particular companies like Asahi Keisai, Takeda, others have been increasingly looking for opportunities to acquire SME type companies in the United States to get a specific technology. In the case of Takeda, Hasegawa-san, the CEO, has sought to increase the global scale of Takeda, which is Japan's leading pharmaceutical company. It's a major global player. So he's made some very, I would say, somewhat risky investments that were pretty expensive. Nycomed was a Swiss company that Takeda acquired, but it's all aimed at a global strategy of increasing Takeda's global presence and competitiveness relative to the European and the US pharmaceutical companies. And this is just to illustrate, if you look at the US, the inbound versus outbound M&A levels is much more balanced than it is in Japan, with the exception probably of 2008. But this is the interesting thing. It's not just cross-border M&A that's low relative to the rest of the world in Japan. It's actually overall M&A activity. So even domestic Japan transactions are low relative to what you see in the other major economies. So for the United States, this is as a percentage of GDP. So you've got, in the most recent year, that's actually misnumbered, my bad, but for 2012, you've got under 2% overall M&A activity relative to GDP in Japan, and you've got closer to 6% in the United States. And so that's a significant element. So now the question is, why is this the case? And here's the points I would make. First, in Japan, you have a strong sense of corporate identity and DNA. And by that I mean, you've got, if someone's a Toshiba person, or someone's a Sony person, or someone's a Mitsui person, they view themselves as that for life. And you see relatively little movement among mid-career people going from one company to another. Now, you often do see, or increasingly see, a Japanese employee in mid-career would go work for a foreign firm, but it's rare that a Toshiba guy goes to work for Sony or vice versa. The practical side of that is that you've got the strong brand and the corporate identity, but you also have very distinct systems. Now, that can include IT systems. In a number of the bank mergers in the 2000s, there were these very notable cases where, 3, 4, 5 years after integration, they still hadn't synchronized their IT systems. And so you still had either separate email addresses, but the basic back office systems were functionally different. And so that kind of gets in the way of smooth and synchronized movement. Personnel systems, operations, all of that applies. And I would just say that when you add the element of a cross-border merger on top of these existing characteristics, that makes it even more complicated. The second is the idea that's talked about a lot. It's the notion in Japan that you have stakeholder capitalism versus what in the United States can often be seen in Japanese circles as this very hyper-aggressive shareholder capitalism. And I'm not going to defend that. I'm just going to say that I'm not going to defend one or the other. I'm just going to say that it's different. But the emphasis in the United States is much more on getting better returns and better corporate performance in the corporations. And so if you look at any measure of ROI, ROE, Japanese companies are much lower on the scale than US, and I think even some of the major European companies. And then lastly, corporate governance issues come into play a lot. And there have been some notable cases in the last couple of years and even in the last couple of weeks that sort of lay this out in pretty clear terms. The emphasis in Japan is on internal, mostly long-term company employees that are on the boards of directors. And some of the Japanese companies have 30, 40 insiders who are on the boards. Makes decision-making process in some ways easier because they're all from the same background, but in other ways it takes longer for decisions to get made in that way. But the notable thing is that there just aren't very many outsiders, and I don't mean foreigners, I just mean non-company people on Japanese boards. Some of this is changing, and there's talk about requirements either from the TSE, the Tokyo Stock Exchange, or under the company law, et cetera, to require that there be independent outside directors. But some of the recent measures that we're talking about included a loophole which basically said if you don't have an outside independent director, you just have to publicly explain why, rather than actually requiring that be the case. And again, that links to the performance element. So how do we solve this? First and foremost, I would say when the Japanese government is thinking about how to increase FDI, don't focus on what I would call gimmicks. And I don't mean that in a critical way. I mean, don't come up with a clever scheme, but focus on the basics. And I think the Abe government has a huge opportunity here to get the basics right. They're emphasizing fiscal and monetary stimulus, but more importantly, they're emphasizing what they call the growth measures through the third arrow. And that's heavily focused on things like deregulation, increasing transparency of the regulatory process, agricultural reform, which could actually increase opportunities both for Japanese companies in the agricultural industry, but also some foreign players there too. But that involves very complicated and sensitive things like changing land rules, changing tax rules pertaining to land transactions, and so forth. But I think, and particularly the labor market reforms, I think are something that I hear time and time again are very important for foreign companies that are operating in Japan. Secondly, it's required as a fundamental mind shift or a mindset change about how foreign companies operate in Japan. One of the things that I've been doing recently is talking about the significant and very important contribution that Japanese companies make to the U.S. economy through their contributions to U.S. output, through their contributions to U.S. employment. 650,000 American workers work for Japanese affiliates in the United States, for example. Very significant number, and so forth. And so Japan, as I said at the beginning, is missing out on that kind of contribution. And so to get to a level where you get that kind of contribution, you have to change your attitudes about foreign investment, and that particularly gets back to the idea of M&A. To touch on a couple of different aspects of this, private equity is a source of M&A activity in the United States and other markets. It's got a bad reputation in Japan, and there have been some cases where U.S. and other M&A or private equity companies went into Japan and they did things the wrong way. They were too aggressive. They wanted to do the thing that they do in the United States, which is to acquire the company, load it up with debt, lay off employees. Does not work in Japan. I've talked to a number of people at very senior positions in some of the major private equity companies. They sort of get it now. They know that they can't go into Japan and operate that way. They know they have to be sensitive. And I appreciate your slide on that. They have to be sensitive to corporate culture. They have to be sensitive to the employment issues, all of that stuff. And I think they increasingly understand that. That said, they also tell me that they can't actually get deals in Japan. Whether it's, and they get close, they get in negotiations and they get close, but they can't actually close the deals, I think, for a number of reasons. And there have been some cases where it was domestic transactions where they went through extensive negotiating periods and they also didn't close because of these cultural differences or management differences. But just to say. The other point is this idea of the big Japanese conglomerates, and I won't name names, but there are a number of them that are multi-billion dollar companies, and they've got hundreds and hundreds of subsidiaries. They can't adequately fund them all. They can't really manage them all. It might make strategic sense to look for partners in the foreign community that would be willing acquirers and strategic acquirers of those operations, which could be characterized as non-core. You see a lot of that in the United States. And so what I'm suggesting here is that the potential is not for an American company to go and buy Toshiba. That is not going to happen. But for an American company could go buy a division of Toshiba or a division of Hitachi. I said I wasn't going to name the names. I violated that. I'm sorry. But just as an example. And there have been some cases where Hitachi sold its hard drive division to Western Digital, but it was kind of a distress sale. So it does happen, but I think it could happen much more. And then a couple of other things. I think improving corporate governance, again, requiring changes in either the company law or additional requirements from the Tokyo Stock Exchange to get independent perspectives represented on Japanese board. And again, it doesn't have to be foreign, but outside company people that have performance of the corporation as a primary goal as opposed to just one that's number 5 on the list in this concept of stakeholder capitalism. Because I think clearly, if you look at the need for higher returns in Japan with regard to their pension system, with regard to equity prices, I mean, we've had a nice run up under Prime Minister Abe, for sure, but that's got to be sustainable, and the only way you can sustain that over the long term is to get better corporate performance. And then you can improve the tax system. And the corporate tax rate in Japan is high overall. There's a lot of talk about reducing that, and I think that's probably a goal that they should strive for. And then you've got a couple of other things that could be done in the tax structure with regard to M&A. 4 or 5 years ago, they introduced a pretty complicated triangular merger structure which would allow stock-for-stock transactions, but there were they didn't go the full 9 yards on the tax aspects of that, and it hasn't been used, I think it's been used only one time. So they can think carefully about how to adjust the tax system for M&A transactions that are stock for stock, and then as I point out in the second point, you can do that also for some cash transactions. And that's all technical stuff, and that's really not the high priority, but it's marginally helpful. And then the last thing I would note is that Greenfield, and this gets to your point about incentives, Greenfield in a large scale is not going to happen in Japan because of the cost structure, and there are just too many other places for a company to go and want to make stuff and then take advantage of regional supply chains and so forth. It can happen in Japan, but not in a large scale. Pharmaceutical industry over the years has invested pretty significantly in R&D facilities in Japan. So I think there are still opportunities for that sort of thing because of the knowledgeable, skilled workforce. You've got some cutting-edge people that are involved in the healthcare field in Japan. Abe government's emphasizing this as a growth sector. So I think that's something to think about. And you can tinker with the incentive structure there to get R&D back in Japan, because some companies actually moved it out to places like China and Korea because of the overall environment in Japan. But that was more about specific regulatory aspects of the Japanese system as opposed to incentive structure. But the one thing that would be interesting is, in your presentation, you talked about what Georgia does. So that's one of 50 states. Every state does this. So there's competition among the 50 U.S. states to attract foreign investment. Sometimes that's healthy. I think if you look at, some economists argue that in a broad macro sense, it's not that beneficial for the overall economy because you get one state playing off against another trying to do this, but it is the current situation. And so for individual states, and if you talk to individual governors, they're doing everything they can to promote Japanese and other foreign investment in their states because it creates jobs and it adds to the tax base and it adds to the communities. So there are ways to get healthy competition in Japan if you tinker, I think, with this notion of decentralized government, but specifically trying to allow the prefectures a little more flexibility in what that they can do. So that's it. I hope I was within my allotted time.
Thank you.
I think we spoke longer than planned, but well, technically we have until 11:30, but since you're not really hungry, I'm sure we can go over a little bit. Are there any questions or comments? Maybe starting with questions. If you have any question, please come to the microphone, state your name and affiliation. Thank you.
Scott Seaman with Eurasia Group. Just wanted to get your thoughts on the idea to create these special zones in Japan that Abe's promoting. And do you think there's anything to that, or is there something that they need to do beyond that? Thank you.
I'm happy to take that. Personally, I'm not a fan of that idea. I think I know politically why they do that, because I think the presumption is that it's easier to do on a small scale, and then you build out and expand. If something's successful, then you take it on a national level, but which would require diet approval. I think what's interesting about Abe's approach compared to what was done under the Koizumi government, and I think there's a direct relation because a lot of the same people are involved. They seem to be talking about making deregulation zones in the major metropolitan areas, in some of the major production areas. So that's kind of an interesting idea, but my own sense, and I think the sense of most people in the business world that I talk to, is it would be better overall if you just go and tackle some specific things like labor regulations or broader regulatory issues that affect industries, etc. The other thing that I'm not a fan of is the idea that you can create special areas in Tokyo for concentration of foreign companies. That's not what, I don't hear foreign companies, I don't hear American companies saying that's what they really need. What they really need is an overall business operating environment that allows them to invest and enter businesses with flexibility and with speed, to get their products and their services approved quickly through the regulatory process, and to have transparency in the process so that they can predict what's going to happen 6 months or a year.
If I could just add to that as well, I think that the problem with special zones is that they're created with political motivations, and they're trying to satisfy particular political goals. That's not what economically companies need. Silicon Valley was not a special zone that was selected. It rose up because of the environment in which it was, and it grew up organically. If you think something is good, if you think that you need to attract foreign direct investment as an example, why not set it free? Why not let it go where it's going to naturally go? If you try and put it in a particular zone that you've decided for a political reason that it needs to be there, what's going to happen is it's not going to be successful because the economy is not going to support it.
Any other question? Please.
Thank you very much for your excellent implications. My name is Isobe from CSS Japan chair, and I'm originally from JETRO. And
I hope we didn't offend.
thank you. We are making the foreign direct investment to Japan as a top priority of our organization activities right now, and we are planning to double the human resources committed to FDI. But do you think the number of human resources committed to FDI is going to improve the efficiency of our activity, or do we have to focus on other kind of structural forms of some kind of things? We would appreciate if you could give implications about this. Thank you very much.
Thank you. Yeah, it's something I did not point out in my presentation. JETRO has been very active. For example, there's a very good website called investjapan.org that details some ways foreign direct investors can enter Japan. And also, a couple of years ago, it launched a subsidy program for promoting site location as well, which led to the investment, I think, by the Belgian firm Umicore for lithium-ion battery factory in Kobe a couple of years back. But I think it cannot hurt. If you double the human resources, it cannot hurt. And what are these human resources going to do? I think in the case of Japan, it's not so much doubling human resources to interact with candidate foreign direct investors. It's more about internally within Japan, maybe selling the benefits of foreign direct investments. Because just looking at my research with mainly French companies and some US companies, a lot of the barriers are internal. It's not a lack of interest from foreign direct investors. These are more deeper, culturally anchored, I guess, discomfort, or it's the old issue of being afraid maybe of the ugly foreigners who's going to strip out the business, maybe like the equity firms. And if you've looked in the news recently, I think there's a US equity firm that bought a substantial share of the company called Seibu, which is one of the large railway conglomerate that owns also supermarkets. And well, I don't remember the name of that big equity firm, but I think it was Cerberus, right? And they got to a point where they had a majority stake or close to it, but they could not get the board to disclose information when they're a major shareholder. So again, there's blockage there. So I would argue, yes, to double human resources, but to turn it inward and tell maybe potential targets or SMEs or even large Japanese companies, hey, maybe you should think about foreign direct investments, being invested in.
I think from the standpoint of foreign direct investment, what I was highlighting that Georgia does with developing social networks and direct human contacts, you need to develop bridge figures. Japan has a very, very low percentage of foreign direct investment. It also has a very, very low percentage of non-Japanese people living in Japan, less than 2% of the overall population. I don't think that this is a coincidence. In Georgia, a lot of the leads that we get from people of, hey, I know my uncle back in this particular country has a business or something like that. In the case of Japan, of course, it's different. We don't have a very large number of Japanese residents, unfortunately. But for many of the other companies that have invested, it's been a personal connection between someone in Georgia and someone back in another country. And I think that Japan really could improve its foreign direct investment by recruiting more of these bridge people.
Yeah, just to touch on that, I think Remy makes an interesting point. The key is what the people are doing, what JETRO, how you're going about trying to promote the FDI. If you're going to focus narrowly on promotion of greenfield investment, it doesn't matter how many people you have unless the overall environment changes. And that's my main point, is that companies will be interested in investing in Japan if they sense that there are opportunities. And as I said in my presentation, getting the basics right, and the government is on the right track here. And I think the other thing that I should mention, which I failed to, is that Japan's entry into TPP is hugely significant, not only because it's going to require some internal changes, but I think particularly because of the signal it sends to the rest of the world. So for the first time in ever, you've got Japan saying we're going to sign up for what is currently the most comprehensive, highest standard trade negotiation there is, and we're going to open our economy. That's an explicit statement and goal of the Abe government, and it's not lost on anyone. That's very, very critical.
Any more question? Come on, we have a few minutes left. Any final comment by some of the speakers?
Well, I just think that one of the things that's been talked about a lot in Japan recently is the so-called Galapagos effect. There is a perception in the outside world that since the 1990s, they feel that Japan has not been innovative. You can see it very clearly, and that's echoed in Galapagos. If you go to Japan, you go to Tokyo, it's incredibly innovative. But there are all these innovations that are being created by companies like Panasonic, like Sony, that they're being sold only in Japan. If you could bring in foreign direct investment, if you could get mergers and acquisition, Nokia just got bought by Microsoft. BlackBerry is trying to sell themselves to whoever can scrape up enough money off of the street right now. I mean, that's, BlackBerry's in trouble. But they're looking for a non-Canadian investor. But Fujitsu and Panasonic just about a month ago announced that they were getting rid of their smartphone divisions. Why, as James suggests, why are they not selling those smartphone divisions to somebody else instead of just rolling it up? It makes no sense. And if they were selling off these divisions because they were not profitable, those innovations would have a much better chance of catching on in the global market, as opposed to now you have these wonderful innovations. You go to Tokyo and you use your cell phone for everything. I wish that I could do that here instead of having to ride the DC Metro and getting my change in $1 coins that I can't use anywhere. I'd really love to be able to just wave my cell phone over the entry and go through and automatically pay my fare to ride the Metro that way. But I can't. In Tokyo, I can do that.
Thank you.
No, actually, James and I had an interesting discussion about this Galapagos syndrome, and I think you make some really excellent points here. I just would close by saying there is, again, enormous potential and opportunity, and now is the time with this combination of policy, but also I think corporate needs. I think things could break open in an interesting way here over the next few years, and I just want to thank you for pulling together this discussion and look forward to further conversation and collaboration, because I think it's a goal that's ultimately in Japan's interest.
Thank you, Jim. Just a few last words. Well, yes, about the Galapagos syndrome. There's, as you said, incredible technology that's being rolled out from Japanese firms for the Japanese market. Well, this is not a bad thing, but it might be a little bit misguided, because great technology for Japan is good, but it should be great innovations in general that can be localized that can be tailored to specific markets. And the Japanese market in itself is not large enough to warrant huge investments that can be rolled out anywhere else. Again, in the example that you gave of what we call the Osaifu Keitai, which is the mobile wallet that's included in most cell phones. This is why I don't have an iPhone. Many of you have an iPhone, right? I don't. Well, first, Docomo does not offer it until next month now. But it's because it does not have the electronic wallet capability. I take the subway every day, and I pay with my cell phone, as in, I think, 200,000 points of sales, except paying with either mobile Suica or mobile, even Edi, or etc. So again, what does it take for Japanese companies to develop technology, not only for themselves, for their domestic market, but elsewhere as well? You have to go back to the roots of FDI actually in Japan. After World War II, Japan grew using an export-led growth model. It was based on export, on high savings rate, the creation of domestic champions. And it actually turned to foreign direct investments very late in the game. So as Jim pointed out, yes, well, it's not about cross-border FDI or M&A, that's very small in Japan. It's just M&A in general as well. And the Japanese like to rely on their own domestic market to begin with. But while Japan has not changed much, the rest of the world has. And this is what Japan is doing right now. It's trying to play catch up with the larger movement of globalization, because the world is not waiting for Japan. Japan has all the tools to succeed, but it just needs to upgrade itself to just keep up with the larger environment. Thank you.